Hi, it's Mark Pfeiffer here, and today I'm going to talk about the difference between return on investment and cash on cash return within the Cashflow board game 202 version. So here's a game card that says fourplex, and as you can see down here, it says 48% ROI. In this other deal card, you see 24% annual cash on cash return. Well, what's the difference between cash on cash return and ROI? All right, well, here we go. I went on to our trusted resource called Wikipedia, and how Wikipedia defines return on investment is, here we are, the gain from the investment minus the cost of the investment divided by the cost of the investment. It says here, a performance measure used to evaluate the efficiency of an investment or to compare the efficiency of a number of different investments. To calculate ROI, this is how you do it. And then one thing that they make a really good point on is to keep in mind that the calculation for return on investment, and therefore the definition, can be modified to suit the situation. It all depends on what you include as returns and costs. The definition of the term in the broadest sense just attempts to measure the profitability of an investment, and as such there is no one right calculation. So I also looked up cash on cash return, and it's a little bit more clear cut than return on investment. It's simply annual dollar income divided by the total dollar investment. So let's use an example here and run through it together. Here is that fourplex card. So let's say you drew this card. Unique building, perfect for young professional tenants. Use this yourself or sell the opportunity. 48% ROI, may sell for $120,000 to $160,000. Cost $100,000, mortgage $80,000, down payment $20,000, and the cash flow of $800 a month. So how would you set this up? Well, here we go. I just transferred over the given data over here. To calculate our cash on cash return, we simply take the monthly cash flow number here that was given on the card and multiply that by 12 to get an annual number, $9,600. The down payment that we had was $20,000 on that card. So our cash on cash return is simply the annual cash flow divided by the down payment. Now, why is cash on cash return something useful to look at when you're playing the game? For me, it's useful because it lets me know how hard my money is working for me. The other way to think about it is, how long would it take, we can also put payback period, how long would it take me to get my initial investment back from this deal? So that's known as payback period. So the payback period here would simply be 1 divided by our cash on cash return. So it'd take about 2 years, 2.1 years, for me to get my $20,000 back. Now that kind of makes sense, because if I took 2.1 years here and multiplied it by my annual cash flow, it'd be $20,000. So that is a good measure. If it was $100,000, that means I would get my full down payment amount back in 1 year. So it's a really good measure when you're comparing different investment opportunities out there to look at the cash on cash return, because it kind of like, it doesn't matter what the cash flows are and down payments, those can range in variance. Cash on cash return is something that can be like a universal measure that goes across all different asset classes, not just real estate. All right, let's go to return on investment. So based off of that definition from Wikipedia, it's basically the gain from the investment minus the cost of the investment divided by the cost of the investment. So in reality, like on this game card, they say 48% ROI, which should really be called cash on cash return, because based off of this definition here, it means gain from the investment over the period of time that investment has been held. So in that case, the way that I would do this is, in terms of the gain from the investment, I would include the gain that you have in terms of the sale gain and the gains that you're getting from the cash flow. So to run through this, we're going to look at a market card here, which is a Plex buyer. So assume this market card comes up. Buyer offers $30,000 per unit for all units in any combination. Duplexes, fourplexes, or eightplexes. Great. So you can sell at this price. So going in here, we have a fourplex. We have 4 units. The price per unit is $30,000. So the offered price is going to be 4 times $30,000, $120,000. Our mortgage was $80,000. So our sale proceeds are going to be the offered price minus the mortgage. Now keep in mind, in reality, there's going to be a lot of other fees when you sell a property, like broker fees, closing costs, that you'll have to take into consideration to get to like a true net sale proceeds that go into your pocket. You also have to consider taxes that you pay, capital gains taxes, unless you do a 1031. But that's all. Let's just, for simplicity purposes, assume that our sale proceeds are $40,000 here, and we'll also assume that the hold period was 1 year. Okay, 1 year. So over that 1 year, we would have made cash flow over hold period. We would have made 1 times the annual cash flow, so that's going to be $9,600. So the gain from investment, it's going to be the sale proceeds plus our cash flow over the hold period, which is $49,600, and the cost of investment, we'll just put our cost, or let's put cost of investment, because that's what Wikipedia had here. Our cost was essentially the down payment. So then our ROI would be, right, gain from investment minus the cost of investment. So we're going to take our gain, subtract the cost, and divide by the cost. And that gives us 148% ROI, which is different than the cash-on-cash return, because the cash-on-cash return only took into consideration the cash flows that we were making, not the sale proceeds. In this example, our gain from sale, we made $40,000, which is doubling our down payment amount, the amount that we put into the investment. So that's a 100% gain, and that's so that is why this ROI is 148%. Is 100% of it is coming from the gain on investment, and 48% is coming from the cash flow return. So I hope this has helped to clarify the differences and also similarities between the two calculations. The big thing that you should remember is to always know how this is calculated, because remember, these kind of terms are abstractions. They have no real concrete basis in reality. It's not something like, let's say, a dog. Right? When you say the word dog, it's referring to an object that exists in reality. Something like the return on investment is a term that whose definition, since it has no concrete, physical, tangible thing in reality, can be the definition of that can be twisted. Not twisted, but it can have different meanings to different people. So that's why it's always important to get the numbers and to see how someone is calculating their return. So one other thing I wanted to share with you really quickly, or show you, was another example here of a game card, which was your toy cells. So in this example, ROI and cash-on-cash return is not shown on this game card, and it's a really good example of showing how you can apply cash-on-cash return to analyze an investment where it's not shown here for you. So in this example, your toy sells. A large toy company wants to buy the toy you invented and pay a royalty of $400 per month for the rest of your life. Pay $12,000 in patent costs to protect your rights or receive nothing. If you pay, add this royalty of $400 per month to your passive income and income statement on your game card. So to calculate cash on cash return here, we're going to look at what's our total cost. Our cost is $12,000. We'll just put toy over here. And our monthly cash flow was going to be $400 per month. So our annual is going to be 400 times 12. So then our cash on cash return is going to be the 4,800 divided by our cost of 12,000. That gives us a cash on cash return of 40%. So now you get to see how this can actually help you to compare investments. This is giving you 40% versus this one of 48%. So where do you think your money's working harder for you? Well, it's working harder over here. 48% is greater than 40%. So here's one last example. Game card is your computer program bought. Industry leader wants your computer program and offers you a royalty of $500 per month for the rest of your life. It costs you $14,000 to prove your exclusive ownership. If you pay, add this royalty of $500 per month to your passive income and income statement on your game card. Here we go to our setup here. So we'll put computer program. Cost was $14,000. Monthly cash flow was $500 per month. So annual cash flow is going to be 500 times 12, $6,000. So that would give us a cash on cash return of 6,000 divided by 14, which is a cash on cash return of 42.9%. So when we compare all these investments, 48% is still the highest, then the computer program is second, and then the toy. So I hope this has been helpful for you to see how cash on cash return can be used in the game, and also the definitions and differences between cash on cash return and return on investment. I look forward to hearing your comments and questions below, and looking forward to sharing more with you in the future.